Hello and welcome to our webinar, Compensation 101, Putting Together the Pieces to Attract, Reward, and Retain. My name is Julie Dorr and I will be your moderator for today's event. Our presentation will last approximately 40 minutes and we'll reserve the remaining time for your questions. Before we get started today, I just wanted to let you know that this audio conference is being recorded and the entire conference is copyright protected. This presentation provides for general information only and does not contribute to legal advice. Or I'm sorry, does not constitute legal advice. We're having a little technical problem here, so I'm just going to take a moment here and get us back on track here. Linda, we're going to have you actually manage the slides today, so I just want to make sure that you're able to do that.
Yeah, that's going so well right now, Julie.
Okay, can you try moving the slides for me right now? Just hold on, everyone. I apologize for the delay, but I just want to make sure we have all our technical things working today.
Nope,
Linda, are you able to move the slides?
Okay, I am not.
Fine. Okay, again, apologies for the technical difficulties. Linda, you want to try it one more time?
I'm trying, not seeing it.
Okay. Well, let me pinch in here and I'll kind of try to run this. And as we get started with the presentation, Linda will try to make sure that you're able to do that. Again, starting from scratch, this is me, Julie Dorr. If you have any questions or anything, feel free to email me during the conference here at Julie at the Dorr Group. Or again, remember you have that question and answer section over. It's typically on the right hand of your dashboard. Just type a question in there, and I'd be happy to answer that along the way as well. So we already heard from Linda, but let me introduce her formally. We have Linda Duffy, President of Ethos Human Capital Solutions. Linda works with business owners and executives to provide strategic human resources direction, develop leadership talent, and increase organizational effectiveness. We also have returning back attorney Marla Merhab Robinson. Marla's with the law firm Merhab Robinson, Jackson, and Clarkson, where she's a partner and head of the firm's transactional department. She primarily practices in the areas of corporate, mergers and acquisitions, real estate, finance, and of course, employment law. And Linda, we have a guest speaker today. It looks like you've got control now of the screen, so maybe you could take it over and actually introduce our guest speaker.
Well, I can certainly introduce her, but I cannot move the slides, Julie, so not sure what to tell you about that. So maybe you can try giving me control again, but if not, I think you're going to have to do that. I am really excited, everybody, to have Laura Conover with us today. I've known Laura for a number of years now, and she is truly a specialist in her field. I know enough to be dangerous when it comes to compensation, but I really feel like this is there's an art and a science to it that very few people have mastered, and Laura is definitely one of them. Laura started out managing a bank a long time ago, and that's where she had her first exposure as part of a management team. She has since then had her own business for over the last 20 years and goes in and works with companies to help them establish whatever it is they need in terms of their compensation structure. So, Laura, thank you so much for joining us today. I'm going to just go briefly over the agenda and then turn it over to you. So Laura's going to talk to us about how to determine base pay and how to manage increases to base pay, which I know I get those questions all the time. She's going to talk a little bit about variable pay, meaning commissions, bonuses, that type of thing. I'm going to touch on the minimum wage increases that are going to happen, and then Marla's going to wrap it up with legal issues, and specifically the California Equal Pay law that was passed by Governor Brown recently. We'll, of course, always take your questions at the end of the presentation, but if you have any as we go throughout, feel free to use your little dashboard on the right-hand side where you can type it in, and then Julie will filter those and ask them at the end of our presentation. All right, Laura, welcome, and I'm anxious to hear what you have to say.
Thank you, Linda. Good morning, everyone. So base pay is the foundation of the total compensation package employers offer their employees. A good set of salary ranges provide the necessary structure for determining appropriate base pay. When looking at base pay, we kind of want to hold two views simultaneously. We want to look outside the organization to determine what it costs to get and keep good people, and we do this through salary surveys. We also need to look inside the organization to make appropriate internal comparisons of jobs for internal equity and fairness. And salary survey data alone does not always capture the value of a job to an organization. Let's talk a bit about survey data, and then we'll look more at internal comparison of jobs. Good survey data that I can rely upon to make pay decisions will usually come from consulting firms, government entities, or trade associations. I'll know how many and which companies participated in the surveys, how many incumbents have data included for each individual job in the survey, and I'll know the location of the participating companies. When I'm matching company jobs to survey jobs, I need to do that based upon job content, not just job title. For instance, many organizations call bookkeepers accountants. To me, accountant means someone with an accounting degree and relevant experience, while a bookkeeper does more routine posting of transactions. Let's go back to the last slide, Linda. I'm still on my first one, thanks. So just remember to match your jobs to survey jobs utilizing the thumbnail job descriptions in the survey. Another very important issue to watch with salary survey data is geographic differences in pay. If you are utilizing an industry-specific salary survey, for instance, and the data is reported based upon broad geographic cuts like the Western United States, that data cut could have very little relevance to you and your organization. In a situation like that, I utilize the nationwide average data for each job and adjust it for the cost of labor where my client has locations. It's important to be clear about the difference between the cost of labor and the cost of living. They are two separate indices. As an employer, you usually want to focus your base pay practices on the cost of labor, not the cost of living. Employees need to figure out how to fund the lifestyle they want based upon the cost of living where they want to live. Employers need to focus on the cost of labor where they have operations so they're not paying too much or too little due to not looking at this data. But in extreme cases, such as San Francisco, where the cost of living is twice the national average, the employer does need to address the cost of living as well. And it's also best to use more than one survey when you are considering survey data for your jobs, and then weight the data as needed. And you usually have to pay for good survey data. The data available on the internet and other places at no charge can be nice anecdotal information, but it's not usually robust enough to use for determining pay levels in an organization. So when we're thinking about really what a set of ranges might look like, next slide please, Linda, we use the mean or average salary survey data for our lowest paid job to anchor the lowest non-exempt range in our structure. We then build the structure up from there with appropriate distances between midpoints and appropriate spreads from minimum to maximum. It's fairly typical to have minimums that are 80% of the midpoint of the range and maximums that are 120% of the midpoints of our ranges. It's also common to see range structures telescope out as they get into the higher level exempt positions, meaning the distances between the midpoints expand and the ranges get broader toward the top of the structure. Once we have our structure set from a market standpoint, we need to check for internal comparisons of jobs to one another. And remember, I talked about this earlier. I said we need to when we're placing our jobs in ranges, we need to look simultaneously outside the organization to see what we need to pay to be competitive. That's what the survey data tells us. And then we also need to look within the organization for internal comparisons of job worth and job value to one another. So we can slot jobs into grades when we have hybrid jobs or jobs for which good survey data does not exist. For example, when we're looking at this small set of sample ranges, non-exempt salary ranges, we may say, gosh, you know, I have a graphic designer that's a grade 9, and that's my first level graphic designer. When I have a set of salary ranges like this, it becomes pretty simple to say, okay, I now need 2 levels of graphic designer. So I'm going to say my grade 9 is my entry level graphic designer 1, and my grade 10 is my graphic designer 2. It's the higher level of that job. Now, if we really want to do a deep dive into internal comparisons, we can use a point factor job evaluation system. But I won't bore you with all the details of that right now, but that's kind of the deep dive into this topic of internal comparisons of our jobs to one another. Most middle market companies will do fine with a set of non-exempt and a set of exempt ranges. They may also want a separate set of executive ranges. But for most middle market companies, the set of non-exempt and exempt ranges will be fine. And when you look at my sample ranges here where we've got overlap between the non-exempt and exempt ranges, this is very common since there are often jobs in the same range that have different exemption status. So here at the top of my non-exempt structure, I have a grade 10, and then I have at the bottom of the exempt structure, I also have a grade 10. And you could have maybe 2 or 3 grades as part of this overlap. It depends on the size of the organization and a lot of other factors. But so this is just a real simple example here, but this gives you the idea of what I'm referring to. It's also important to note that salary ranges need to be adjusted every year since pay data is always changing. The past few years, ranges have increased approximately 2.2%, which is kind of across the board. So now let's talk about increases to base pay. The most typical way organizations increase base pay is through the merit increase. And when that is done well, the amount of the merit increase is based upon a performance rating that comes out of a robust performance review. One of the things that I like to point out about this topic is I think it's really important to, as best you can, within your merit budget, differentiate amongst your employees with respect to performance and the amount of the merit increase you give them. You know, if you tell me I'm a superstar and that's, you know, I'm rated a 4 or a 5 on a 5-point scale for performance, and I get a 4% merit increase, and I know that the people who work around me who are 3s on that 1 to 5 scale are getting a 3% increase, I'm not really being told through the pay that I'm receiving, that pay increase that I'm receiving, that I'm truly a superstar. Now, you can also, of course, address my stellar performance through variable pay plans, and I recommend that. But I also think that this matters in base pay increases as well. Another way that we make adjustments or increases to base pay is through market pay adjustments. So when we find out through utilizing good survey data that some of our folks are being paid low compared to market, we want to make a market pay adjustment. And you want to make it clear to people that these are one-time events. These are not something that happen year over year. This only happens, you know, once in a while, and probably once, you know, for most folks. But we want to put that in writing as well, that this This is a one-time event. We're making this market pay adjustment for you. Lump sum adjustments are not actually added to base pay, but we use them when we have people who are at the maximum or over the maximum of their salary range. And we basically figure out what their merit increase would have been based upon their merit rating, and then give them that amount in a one-time payment and clearly explain to them that their pay is over the maximum of the range, and the maximum of the range tells us kind of the maximum economic value of their services to our organization. And so because of their pay is over the max, we're giving them this lump sum, and we're giving it because they're still a great performer, or at least a solid performer. Next year, if they're not still a good performer, I wouldn't give them a lump sum. And also, this lump sum adjustment is very advantageous to employers because every time you add to base pay, you're kind of increasing those annuity payments, that stream of payments that you owe people year over year as they stay with you. And this way, you're at least not increasing the amount of those payments if you're not getting the great performance in return. Now let's talk about kind of the pitfalls of discretionary bonus plans. I just have a real hard time with these because I'm not seeing how they signal to people what we want them to do to get bonuses in the future. And I think that they really aren't used for employers to kind of get the biggest bang for their buck, so to speak, through bonus payments. And we also know through surveying people and kind of research that when people don't know how their pay is calculated, this applies to bonus payments as well as base pay. When they don't know how their payments or their pay is calculated, they assume they're not being treated fairly. So if we can at least say to them, we have a rational, well thought out, objective system for determining base pay, and we have a well-structured bonus plan that we're using to determine your bonus payments. When we can do that, people are going to at least feel better about what they're getting. They'll always want more because they're human beings, but that's just part of the picture. But at least with structure, they're going to feel like what they're getting is more fair. So let's go to the next slide, please. What's so good about non-discretionary bonus plans? They can really be used to highlight both financial and non-financial goals and objectives of an organization year over year. And they can be used to point our employees towards what we need them to do to help the organization move from point A to point B. And most importantly, they help employees understand what they need to do next year to get another bonus if they got one this year. So let's talk about cash bonus plan design basics. Cash bonus plans can be used very effectively to support the annual financial and non-financial goals of an organization. There are many issues to consider with bonus plan design. One of them is payment timing, which depends upon business cycles and accounting data. If you have fluctuations in revenues and expenses across quarters or other seasons, it's best to pay annually so that you are capturing all the financial results of a given year absent aberrations due to cyclical swings. Another issue is the target bonus amount for each participant. If, for instance, you are creating a cash bonus plan for all the non-management employees in your organization, you might consider target percentages of base pay tied to job groupings like lower level non-exempt, mid-level non-exempt, lower level exempt, etc. Similarly, an annual cash bonus plan covering the management and executive team in a middle market company may have target bonus amounts of about 10 to 15% of base for the managers who report to the executives, and 20 to 25% for the C-level and director executives. The CEO could have target bonus percentages in the 25 to 50% or higher range. None of these numbers are hard and fast guidelines. They are what is typical and do vary across industry, company size, and other factors. Something else to consider with management and executive plans is the mix of bonus opportunity between individual goals and company financial results. For instance, the CEO's bonus opportunity should be based entirely on company financial results, since they have the most responsibility and authority to control those numbers. The people who report directly to the CEO might have bonus opportunity based 70% on financials and 30% on individual job-related goals and objectives. And the mix for managers might be 50 to 60% overall company financial goals and the remainder personal objectives. Again, these percentages are guidelines. Good bonus plans are not available in templates. Each one must be custom designed to meet the objectives of the organization, and they need to be reviewed year over year for effectiveness. Let's go to bonus plan documentation and communication. In California, per a 2013 law, it's now a legal requirement that all variable pay plans be in writing. Not only is this a legal requirement, but it's a really good idea because just as with any other policy or procedure that we use for our employees, having a written document becomes a guide to help us implement these plans in a consistent way. And it forces us to really think through, when are we going to pay this thing? When are we not going to pay it? What happens if people start during the year or leave the plan or the organization during the year? So they must be in writing. And we really need to make sure that people understand how they can affect the results. You know, this may seem simple if we're kind of sitting at the top of the org, but for the folks who are not at the top of the org chart, this can be a little more challenging to understand how we can affect results. And as with so many things that we try to tell employees, it's hard to over-communicate bonus plan metrics and the structure of the plan and how it works. The communication really needs to go on all year long. I have a client that does this very actively through their internet. They post their financials every morning. They are there for people to see them all day long, and people know, okay, that's where the numbers are. Here's where I am with my bonus as of today. So it's really effective. So now we're going to move on to commission plan design. The first issue is, are your people inside or outside sales reps? Inside sales reps typically need to be non-exempt, and I think you need to be even more clear with them than outside sales reps when it comes to thinking about paying commissions. What new business are they truly responsible for developing? Are they taking orders from incoming calls, or are they making outbound calls to develop new clients or sell more to existing clients? Developing commission plans requires determining the measures of sales performance that will be used. Some common measures are sales volume, revenues, market share, net or gross profits. It's really important to focus on margins and ensuring your salespeople are making profitable sales, not just a lot of low margin sales. The base commission mix is also very important in commission plan design. The type and cost of goods or services being sold, The length of the sales cycle are also things that will help determine the mix. The more the sales rep is required to have ongoing service-related contact with clients, the higher the base pay must be to compensate. And, of course, all commission plans must be in writing, just as bonus plans should be. Finally, the best bonus and commission plans are deceptively simple. Complicated plans are not motivating. It's worth it to take the time to develop plans that meet the criteria you need to meet and figure out how to explain to people what they need to do in straightforward ways to earn their bonus or commission. When you do that and communicate the plans and metrics all year long, you should have effective plans that support the goals of your organization year over year. Now Linda's going to make some comments about some wage and hour law issues.
Laura, thanks so much for that. And I couldn't agree with you more about bonus plans and commission plans being as simple as possible. One of the rules I always share with people is don't screw with somebody's paycheck. And if they don't understand how they can make money, or if you mess around with their increases or bonus structure, anything like that, it's the first thing that will give you an employee relations problem and possibly a lawsuit. So let's all try to avoid that. I wanted to just tag team with Laura on a couple comments about bonus and commission plans. The couple of areas that I see come up a lot when I draft these for clients is defining when the money is earned. So for example, let's take a commission plan. Is the money earned when somebody signs, a purchase order? Is it earned when the product is shipped? Is it earned when it's invoiced? Is it earned when it's paid by the client? There's so many different ways to do it, and if you're silent on that, it's not going to bode well for you as the employer. So you want to make sure that you're really clear about defining when the commission is actually earned. And secondly, that goes along with what happens upon termination. If you've done a good job defining when it's earned, then you might not have this problem. But if you don't say, what happens at termination? Are they allowed to earn commission for sales that were in process, only sales that were closed before their last date, that type of thing. And there's not necessarily a right or wrong way of doing it. It's just that you want to be really clear. I've got clients that define it at various steps through the process, a sales process. So it's not so much that it's right or wrong as much as you want to be clear up front so you don't get into a dispute later about it. Now, something else to remember about commission plans, bonus plans, anytime you have any sort of, we'll call it extra income involved, is when you have non-exempt employees, when you're calculating overtime, when you're paying sick pay, when you're paying other types of premium pay, you have to pay it based on the regular rate, and I mean the regular rate and not the base rate. And I see a lot of confusion among this concept, so I wanted to go over this slide real quickly. This is a slide from our Tricky Payrolls webinar that we did a few months ago that's out on our YouTube channel. So I'm not going to go through the slide in detail except to remind you that there is a difference between base rate and regular rate, and you need to be able to do that calculation. So for example, if you've got somebody you're paying $10 an hour to as an inside sales rep and they made $150 a commission this week, but they worked overtime, you're not paying that premium at half of the $10, you're paying it at half of the regular rate. So in this case, when you fold all that money in, divide by the number of hours worked, you're going to get $13.41. That's the regular rate, so half of that is that premium rate. So you just want to make sure that you're paying it appropriately. I have a client, and the reason we were introduced to the client is because they were paying people a flat weekly travel time. It was a construction company, and they were paying them a flat amount to cover all of their mileage and everything for the week. It was paid through payroll. She was paying overtime at time and a half, so she was trying really hard to be compliant. She didn't know this law, and she had a DOL audit, and so she ended up not only having to engage an HR consultant, which was obviously to my benefit, but she needed to she needed to go back and pay money to the employees, and she had interest and penalties on top of it. So it was several thousands of dollars that she ended up in the hole. So we want to try to avoid that. The other thing I want to touch on before I turn it over to Marla is we all know that minimum wage is going up again. Hopefully you all know that in California. So if you remember July, so almost a year and a half ago, it went up to $9 an hour. January 1st of next year, it's going up to $10 an hour. Now that's for the state overall, which is obviously higher than the feds. It also could be lower than some specific cities. So like San Francisco's at $12.25 an hour, San Jose's at $10.30 an hour. There are other cities that have it indexed, so it goes up. Los Angeles just passed a law that's indexing that, so it's going to go up to $15 over the next few years. San Francisco's index is going toward $15. We'll see what happens after the election, and there's already bills that have been introduced in California to index it and take it to $15 an hour. The reason I bring that up is obviously for a couple reasons. One is you need to make sure you're complying and you're bringing your minimum wage people in at $10 an hour, but that's also going to impact the minimum salary for exempt status. So in California, if you look at the wage orders, one of the requirements is it's in order for someone to be exempt, setting aside the duties requirements, right? In order for someone to be exempt, they have to be paid twice minimum wage in a salary. So right now that's $37,440. Is going to be going up to $41,600 effective January 1st. So not only do you have to look at just bumping up anybody that's making less than $10 an hour, I want you to go back and look to see for your exempt people, is everyone at a salary of at least $41,600 per year? Because if not, you're either going to have to convert them to non-exempt or you're going to have to bump up their salary. The other reason I bring it up, and this is a great question that Laura may want to weigh back in on when we go in the Q&A, but you also could potentially have some wage compression, meaning you've got people right now that maybe you brought them in at $9 an hour this month. Now you're going to turn around and bump them up to $10, right? So then you're bringing in new people at $10 an hour. Maybe you have people that have worked for a year and are still at $9 an hour. So you have to automatically take them to 10, but now you've got people that are entry level making 10 and people that have been there for some time making 10. That's going to be difficult for a lot of employees to understand, and you're going to have to give some thought to what you're going to do about that. Are you going to bump them up even higher than 10? What are you going to do so you can have a little bit of gap in between the people that are truly entry level and the people that are making a little, that have been there a little bit more? So you can run some models to see how that plays out, but just give it some thought because that's another issue that can cause some employee relations problems. And with that, I'm going to turn it over to Marla to talk about the equal pay law that just got signed by the governor.
Yeah, thank you, Linda and Laura. And I love the theoretical part of all this, and I just wanted to point out to everybody that both California and federal law prohibit you from not allowing your employees to talk about their pay, and just remind everybody that they do. And so that morale is a big part of this, and Laura, I loved how you touched on that. So October was a busy month for Governor Brown. On October 6th, he signed the California Equal Pay Act. It seems like a no-brainer since we already had an existing Equal Pay Act that prohibited an employer from paying an employee less than rates paid to the opposite sex in the same establishment for equal work on jobs requiring equal skill, effort, and responsibility, and which are performed under similar working conditions. The amendment removes the requirement of in the same establishment, and it also prohibits an employer from paying an employee less than rates paid to the opposite sex for substantially similar work when viewed as a composite of skill, effort, responsibility, as specified. The basic difference is the existing law required it to be the same job in the same establishment, and the new amendment is the similar job, and it does not need to be in the same establishment. And of particular importance here is, the starting wage. That's where most employers have issues here. The LA Times dubbed this amendment one of the toughest equal pay laws in the country. So of course we're expecting to see lots of lawsuits in this area. Brand new, just as I said, October last month, signed October 6th. Next slide, Linda. The new amendment requires employers to demonstrate that the wage differential is based upon one or more specified factors. So obviously can't be based on the difference in sex, but it can be seniority, merit, quantity or quality of production, or a different bona fide factor other than sex, such as education, training, or experience. In my opinion, this is another great argument in favor of job descriptions. What skills required, what effort is required, what training is required, what education is required. I know a lot of employers don't write down the training or education or experience that's required in job descriptions, just what the employee is expected to do. And I think that that should change, and we should see that here. I think it will help in defending these cases that, of course, we're going to see. Each factor is relied upon is applied reasonably, and it can be just one factor that can allow for unequal pay, but we want to look at the entire differential. The amendment increases the record-keeping requirements from the existing 2 years to 3 years, and it will be administered and enforced by the DLSC, which of course means that the employee does not need an attorney to represent him or her to bring a claim here. The employee does have the right to bring a civil action and use an attorney or pro bono. The potential damages are back wages and interest, but write this down on your slide, please. The more horrible part of it is that it's also liquidated damages equal to the back pages. So it's a 100% penalty, and attorney's fees if there is an attorney. If the employee has been discharged, another remedy is reinstatement. Also in October, and I don't have a slide for this, I just want to mention it. Linda and I had mentioned it in a previous webinar, but on October 10th, just 4 days later, Governor Brown signed legislation that imposes new requirements on employers who pay workers on a piece rate basis. I bring this up now because there are certain actions that need to be taken if you are an employer who pays on a piece rate basis by July 1st of 2016. The new law added a new provision to wage payment law requiring employers to pay workers for rest and recovery periods and other non-productive time at or above minimum hourly rates. And that's separate from the piece rate compensation. In the past, employers would just pay for the piece rate for completing the piece, and if the employee was doing other work that had nothing to do with putting together the piece, the employer did not pay for that. So that's been defined as other non-productive time, and that has been held to mean time under the employer's control, but it's not rest or recovery periods, but that is not directly related to the activity being compensated on a piece rate basis. So employers are required to separately state on itemized wage statements that your paycheck stubs the hours that are compensable for rest period and recovery periods, the rate of compensation, and the gross wages paid for those periods during a pay period. Again, there are some affirmative defenses that are going to be available to employers who take action with respect to past due wages for this, for back pay, because it can go retroactive if certain actions are taken by July 1st, 2016. So the reason I bring it up here is to encourage you to seek out an attorney or an HR consultant to help you with that if you are a piece rate employer. I also want to give a little plug to Laura. I have used Laura's services in the past to help me with clients who weren't sure what wages to pay or what salary to pay an incoming employee or professional, and she has great resources available to her. I think, Laura, when I called you, I needed to know what a salesperson in the Irvine area with 6 years experience in manufacturing with the employer's revenues at $24 million, what was the pay? And I can't remember all the parameters, but that's the type of parameters you can give Laura, and she can give you that low, medium, and high that she went over in her first couple slides. So with that, I will turn it over for questions.
Well, that is a great plug. Thank you so much. And again, sorry for the rough start, but I think the content here was quite remarkable. Which leaves us now, we've got about 20 minutes or so that we can actually ask and answer some questions. And I notice we have quite a few in, but let me just remind you how to do that again. There is a Q&A section over on the right-hand side in your dashboard. You just type your question in and then send it, and then I will read it aloud for Marla, Linda, or Laura to answer. And you can also, of course, email me. My email address is julie@thedoorgroup.com. So let's get into some of these questions right now. And again, we have 20 minutes or so, so I'm going to kind of go through and combine some of these just so we get everybody's question answered today. Chris starts out and is wondering, and this is probably more for Laura, any suggestions for data mining or buying? I'm assuming it's, you know, obviously the different job descriptions and the pay rates and the high or the low, medium, high. Laura, do you have any suggestions for that?
Yes, my favorite source for, especially, well, let me put it this way. One of the basic things that I have in my toolkit all the time is data from ERI, the Economic Research Institute. They have data on over 7,000 job titles, and it's broken up into kind of two different sets, actually more than that, but the basic set has data on like 6,000 or 7,000 jobs that are below director and VP level. And this is kind of what Marla was mentioning earlier. Thanks for the plug, Marla.
You're welcome.
But this data can be adjusted for industry and company location, and then it will also tell you, based on the number of years experience, the kind of the data spread for each year of experience. And then for the director and VP and up and the C-level jobs, that data can be calibrated for industry, location, and company revenues. And then they also have a separate database for management level jobs in nonprofits. So that's really good. And then if you are in a specific industry or you're a specific type of nonprofit, for instance, I have a client that is a medical clinic. And so there's a specific survey for community medical clinics in California. So we use that when we're updating their ranges. But you know, you do want to look for industry-specific surveys, and then having something like ERI on your desktop for cross-industry jobs. You know, cross-industry meaning human resources, accounting, IT jobs that we see in all industries, as well as industry-specific jobs. They have that data as well.
Great. Linda, Marla, do you have anything to add to that?
Yeah,
nope.
I'll just say this because Laura's my go-to person, obviously. I used to subscribe to the data, but it's very expensive, and I don't do enough of this dedicated work to make it worth my while. So not only do you have to buy the data, but then you have to know what to do with it as well. So I'll just add that word of caution. You might be able to get some data if you belong to a specific association, like National Association of Manufacturers, for example, might have some data, something like that. But in general, if you just need some basic information, or if you don't have the expertise at the time to do it in-house, don't waste your money on the survey. Spend your money wisely and just engage Laura to do it. That's my rule of thumb.
Yeah, exactly. Yeah. Like for some, for a couple of job titles, I, you know, resell the data from ERI and I make it very clear that's where it came from, etc. So that's something I do routinely.
And I would add to echo Linda's comments. I was surprised at how inexpensive it was to call Laura, and I've done it more than once, and I've sent clients to Laura to say, you know, you're looking for this particular position or positions, call her and get this data, and rather than paying for the data on a monthly basis, just pulling out, having Laura pull out the positions was very inexpensive.
Good. Good. A great resource. Laura, this question is, we got quite a few flurry of questions, and I think this one is directed for you as you were talking a little bit about the variable pay plan and that California requires that in writing. Chris and Lynn both were wondering if you could share a little bit more on the details of that and where they could find the specific law so they could, you know, make sure that they're in compliance with it.
Actually, I'll send that over to our attorney, Marla.
Oh, yeah.
Can you help us with that?
I can. Give me 1 second. I'll pull it up. It's a labor code section. And just to clarify, it's commissions and bonus plans. Short-term bonus plans are excluded from it. Bonus and profit sharing are excluded from it, except if your bonus or profit sharing plan pays a fixed percentage of sales or profits, which they usually do, and so that's what brings it into the labor code section. So I'll pull it up, and if you want to ask the next question when I'm pulling it.
Yes, I will. That will be great. Because Dora's wondering too.
Julie, hold on, I got it. It's Labor Code Section 2751. It went into effect January 1st, 2013.
Correct.
Okay, good. Okay, because Dora has a question too about bonus plans. Do they all need to be in writing, and must the employee sign an agreement to the plan as well?
Okay, so I just said no, they do not all need to be in writing, unless they are a fixed percentage of sales or profits. All commission plans need to be in writing, but short-term bonus plans are excluded, and profit-sharing plans, unless, again, they are paid on fixed percentage or sales or profits, which most of them are. So to default on the caution, you should put them all in writing, and yes, the employee does have to sign and obtain a receipt. The employer has to get a receipt from the employee that they got it. So a copy of it being signed would be the receipt.
And staying along that line of questioning, Marla, is there a specific amount of notice? Like, say if you're going to change a bonus plan, is there a certain amount of notice, and does that need to be stipulated in that plan? Dora's wondering.
Well, there's nothing in the statute that says this much notice, but what we always advise is at least one pay period's worth of notice.
Okay.
And let me add on
then at least.
Julie, let me just add on to that, and Laura might also. What we do when we write it in is we always put a disclaimer in there that the employer reserves the right to change the terms and conditions of this at any given time. You also need to make sure that you're putting the period of time that the agreement covers. So, for example, if it's for 2015, you want to say that this is for 2015. The one other thing to keep in mind is that if you don't change it, then it's going to be assumed that it continues in perpetuity until you cancel it or you change it in some way. So you want to make sure that you're really clear about period of time. So normally we would write them for a year, and then we would update it, and it may be only changing the dates, but we would update it for 2016 and so forth.
Okay, correct. Good. Laura, did you have anything you want to add?
No, I think that's all. Those are all really good comments. I think that handles that question at a good level right now.
Okay. With the specific concept of wage compression that we were covering, what would you recommend your clients to do with the wage increase for the more seasoned employees versus the newbies being hired? What would be your recommendation to a client on how to handle that?
Well, what I think you need to do is, kind of start a spreadsheet so you can see hire dates of people, like when did you hire them into your organization, and when did they start in their current position, so you know, okay, how long have they been with us, how long have they been in their current job title, and what has their level of performance been. That matters too, and that matters a lot to me, actually, is performance and not just tenure. And you want to kind of see what will happen. Okay, if I raise the floor is now $10 an hour, then looking at my existing people, and you have to look at each one individually and look within job titles. That's very important, is you kind of want to isolate folks within job title. What happens when I raise the floor? And as Linda had mentioned earlier, if that means I now have existing people in a job who are paid the same as or very, very close to what new people are making because of this increase in the minimum wage, then I need to kind of model in my spreadsheet what it would look like and what it would cost to increase pay for folks who are already in these jobs, already doing these jobs. And you want to have some rationale behind it. You want to, give more to people who've been with you longer and who have been better performers. And you kind of want to think about, it is an opportunity, I think, to really think about, if you haven't before, do I value performance more than tenure, or vice versa, or would I weight them similarly? Because if you can say, I really want to pay more for performance because that really matters to me, and that kind of points more towards, gee, what are they going to do for me in the future, then you want to take that into account and really drill down on performance ratings and the performance of your folks, and considering how much you might increase them. So this, and of course this I know is all done within the context of budgetary constraints. Every organization has budgetary constraints. So you kind of have to go back and forth and look at what you want to do for individuals based on their tenure and performance, and so that you won't lose good people in the midst of these changes. And then what are my bottom line total increases to payroll expense as I consider these changes?
Okay, great. Linda, Marla, did you want to weigh in on that question at all?
Nope.
Not me, but I thought Linda might.
Nope, I'm good.
Okay. We also have, and this is probably the best question in terms of, what everybody struggles with here. We want to know, what is your opinion on an employee who has worked for so long for a company and received merit increases throughout employment to the point where the employee is now far above the maximum salary range because, they've been there for a while, and for similar positions in the same geographical area. So how do you motivate or continue to provide merit increases when you have someone that's kind of maxed out in their salary range?
That's a really good question. So, and we see this a lot. And my first step would be to really explain to the employee, we have this salary range structure because it helps us really clearly see minimum and maximum values of our jobs to our company. And this isn't, we're not valuing people. Jobs are these inanimate objects, so to speak, that are really separable in my world from the people who perform them. And that's how I look at pay, particularly base pay. And so you really want to try to help people understand, this isn't personal. We're not valuing people, we're valuing jobs, which is, those are two very separate activities. We express how we feel about people and their performance in the organization when we give them their performance review, and we go through the whole performance review exercise. That's when we talk about individual people. So in this instance, where we've got folks who have pay who that is above the max of the range for their job, I think it's really good to give them a lump sum increase based on the amount of, that the merit increase would have been if I was going to add it to base pay. And I make it clear to folks that, this is what we're going to give you as a one-time payment for your job performance for last year. And as long as you keep your performance good or strong, or even better than that, then you'll get another one of these next year. But at least this way, if their performance starts to suffer, I don't have to I'm not continuing to pay that lump sum, and I'm not going to pay it into the future if their performance suffers.
And that's separate from the cost of living increase, correct?
Yes. I think of cost of living adjustments as being kind of an across-the-board same amount that we give folks in kind of more government or union environments. I think if we're talking about wanting to pay for performance, then instead of looking at cost of living adjustments, we want to look at merit increases where we are paying more to our high-performing folks based on the merit increases, the merit ratings that we're giving them, that again should be based on a real robust merit or performance management system. So
I want to thank Laura for pointing that out, because a lot of employers and employees especially expect that or think that cost of living increases are required because the employees expect them. And certainly in the union context and the government context, they're there. In the private sector, however, you could have the cost of living increases, which are, based on indexes, increasing. However, your particular industry may be decreasing, and not your particular company may not be profitable, in which case it's not appropriate to give everybody a cost of living increase. So one of the things that Laura has said over and over again today, and I appreciate it so much, and Linda has confirmed it too, is communication is key. You've got to communicate the why and how, and that, even if you get a great performance appraisal this year, you may not get a merit increase because the company may have lost money this year.
Right. And just to kind of add again, a cost of living adjustment, again, they're the same amount paid to everyone. And so if I'm a stellar performer and I'm in an environment where the annual increase to base pay is a COLA, that's a complete non-starter for me. That's like, why bother being a great performer, because I'm going to get the same increase to my base pay that everybody else is going to get. So that's why my personal bias is absolutely towards merit-based programs and paying for performance.
Great. Well, unfortunately, that is all the time we have for questions today. I just want to thank Linda, Marla, and Laura for an excellent overview on compensation programs. Of course, their contact information is in the slides in their bio section, so you can certainly contact them. But now I want to take a minute. Linda, you have a special invitation for people online. Can you kind of explain what you've got here?
Yeah, I do, Julia. Thanks so much. One of the things that I hear from clients over and over again are some of the issues they have with their teams. It could be things like we don't trust one another, people withhold information, we work in silos, I can't motivate them, we have conflict, all sorts of different things. And there's a great model out there called the 5 Behaviors of a Cohesive Team. There is an event in Irvine on December 2nd in the morning for a couple of hours where this is published by Wiley & Sons. I'm an accredited or authorized partner of theirs and do this type of facilitation. Their senior brand manager is going to be here in Irvine to do a showcase. If you lead a team, if you're an HR professional, you're a business owner, and you have an interest in attending to learn more, please email me and I will invite you as my guest to attend along with me. Again, it's for business owners, CEOs. If you lead a team of like 4 or more people, then this is a model that you should be interested in because it can radically improve the cohesiveness and the effectiveness of your team. So I would invite you to join me for that. Lastly, we are going to, we have not scheduled yet the next month, or I'm sorry, in December we're going to be dark. Julie, I can't move the slide again for some reason. In December we're going to be dark, but we'll be back in January with a new webinar, and it will be new laws for the new year like we always do for a date to be determined, but if you're on our mailing list, you'll get that. So hopefully you can join us for that. Thankfully, there haven't been a ton of new laws so far. There's still, 5 weeks to go, though, so who knows. But we'll be back to make sure that you're up to speed and give you any information you need to stay compliant and move your business forward.
Great. All right. Well, thank you all so much. We certainly appreciate your time today, and we look forward to providing you with more useful information in the new year. Have a safe and happy holiday season.